Property and investment strategy. 1. Spotting high-yield properties in urban areas. Location fundamentals. Proximity to employment hubs, universities, transit links or healthcare facilities attract steady tenants. Upcoming infrastructure projects often signal future price growth. Demographic fit. Young professionals and students typically favour smaller, affordable units. Families may seek larger homes, but with lower yield potential. Property characteristics. Studios and one-bed apartments often deliver stronger percentage returns than large houses. Low maintenance finishes, secure entry systems and communal amenities reduce turnover. Market timing. Off-peak seasons can reveal motivated sellers and negotiable prices. Monitor interest rate cycles to lock in favourable borrowing costs. 2. Bond versus cash purchase. Pros, cons and hidden traps. Cash purchase pros. Faster closings win competitive bids. No interest expense over time. Cons. High capital outlay limits diversification. Opportunity cost if other investments outperform property mortgage purchase. Pros. Leverage amplifies buying power with smaller down payments. Frees cash for other opportunities or reserves. Cons. Interest rate fluctuations can squeeze cash flow. Default risk if rental income or personal cash flow dries up. 3. Rental income versus capital appreciation. Which matters more? Rental income, yield, generates immediate predictable cash flow for expenses and profit favored in markets where yield outpaces average borrowing costs. Capital appreciation, growth, builds long-term equity as property values rise. Key if you plan to refinance, flip or leverage equity into new acquisitions. Balancing, both prioritize yield if your goal is steady, monthly returns. Emphasize growth when targeting wealth accumulation over a decade or more. Seek markets offering positive cash flow plus signs of future appreciation. 4. Leverage, using debt to build wealth without drowning in it. Good versus bad debt. Good debt acquires income-producing assets, rental properties, businesses, bad debt funds. Consumption, luxury purchases, high-interest credit cards. Key leverage strategies. Rental mortgages. Tenant rent covers loan repayments and builds equity portfolio loans. Borrow against existing investments to diversify into real estate business expansion loans. Fuel growth when projected returns exceed borrowing costs. Risk controls. Keep debt service below about 30–35% of your total income. Maintain emergency reserves for vacancies, repairs or rate hikes. Re-evaluate leverage levels when markets soften to avoid forced sales. 5. Real estate myths that keep people broke. Myth. You need a huge deposit to get started. Fact. Many lenders offer low deposit or 100% financing options for qualified buyers. Myth. Only peak seasons yield the best deals. Fact. Off-peak windows often uncover motivated sellers and less competition. Myth. Bigger homes always appreciate faster. Fact. Location and demand dynamics usually outweigh property size. Myth. Skipping an agent saves money. Fact. Experienced agents can net higher sale prices and navigate complex paperwork. Myth. Renting is throwing money away. Fact. Renting can free capital for higher return investments or business ventures.